The global financial system runs on short-term trust. Every day, trillions of dollars are borrowed and repaid overnight in a market most people have never heard of. It is called the repurchase agreement market, or simply the repo market. Banks, hedge funds, and institutions rely on it to finance government bonds, trading positions, and balance sheets. It is not visible to retail investors. It rarely appears in headlines. Yet when it stops functioning, markets seize within hours. In 2019, a sudden disruption in repo funding forced central banks to intervene urgently, not because banks were insolvent, but because liquidity had tightened unexpectedly. This is the story of the market that funds everything, and what happens when overnight confidence disappears. A repurchase agreement is a short-term loan secured by collateral, typically government bonds. One party sells a security and agrees to repurchase it the next day at a slightly higher price. The price difference represents interest. The mechanism is simple. The scale is enormous. The repo market allows financial institutions to fund large portfolios efficiently. Government bonds serve as high-quality collateral. Because the loans are short-term and secured, they are viewed as low risk under normal conditions. Banks use repo to manage daily liquidity needs. Hedge funds use it to leverage positions. Dealers use it to provide market-making services. The system depends on the assumption that collateral remains acceptable and counterparties remain trustworthy. Repo transactions are rolled over continuously. What is borrowed today is repaid tomorrow and renewed again. This creates flexibility. It also creates dependency. The repo market promises efficiency and stability. Because loans are collateralized, credit risk appears limited. If a borrower fails, the lender can seize the collateral. This structure supports leverage. Institutions can borrow against high-quality assets and deploy capital elsewhere. Balance sheets expand without relying solely on deposits. The promise is liquidity. Government bond markets remain deep because repo provides financing to those willing to hold inventory. Short-term borrowing reduces funding costs. The broader assumption is continuity. As long as government bonds are trusted and counterparties perform, the system functions smoothly. Central banks reinforce this trust by acting as lenders of last resort. In theory, repo disruptions can be addressed through temporary liquidity injections. The flaw in the promise lies in correlation. If many institutions face stress simultaneously, collateral may decline in perceived quality. Lenders may demand higher haircuts or refuse to roll funding. Repo works perfectly until participants hesitate. The modern repo market expanded alongside the growth of government bond issuance and global trading. As sovereign debt increased, so did the need to finance large inventories. Low interest rates amplified leverage. Hedge funds borrowed cheaply through repo to amplify returns on small spreads. Banks optimized balance sheets by financing securities short-term. Post-2008 regulation reduced proprietary trading within banks, but increased reliance on collateralized funding structures. Central clearing mechanisms improved transparency in some segments, but large portions remained bilateral. The repo market became foundational infrastructure. It supported treasury markets, derivatives, hedging, and institutional liquidity management. Because it operated smoothly most of the time, it attracted little public scrutiny. Disruptions were rare and often resolved quickly. The rise of repo was not speculative excess. It was structural necessity. The scale reflected the size of modern financial markets. What few questioned was whether overnight funding could remain stable under sustained pressure. Repo fails when lenders withdraw or demand higher collateral margins simultaneously. Even small changes in haircuts can force deleveraging. If lenders increase required collateral, borrowers must either post additional assets or unwind positions. This can trigger selling in government bond markets, ironically reducing the value of the very collateral securing loans. The system is tightly interconnected. Treasury markets depend on repo for liquidity. Hedge funds depend on repo for leverage. Banks depend on repo for balance sheet flexibility. In 2019, repo rates spiked unexpectedly as cash demand surged and liquidity tightened. Funding costs rose sharply. The disruption required rapid central bank intervention to stabilize conditions. The stress did not originate from insolvency. It originated from imbalance. Demand for cash exceeded supply in short-term funding markets. When repo contracts, when leverage contracts, asset prices adjust. This dynamic can amplify volatility even if underlying credit quality remains unchanged. The vulnerability lies in scale and simultaneity. Overnight funding works when confidence is continuous. It becomes fragile when uncertainty increases. Repo is not inherently unstable. It is conditionally stable. The system fails when participants assume that rollover is guaranteed rather than negotiated daily. A severe repo collapse would resemble a liquidity seizure rather than a bank failure. Funding would dry up. Institutions would reduce positions rapidly. Government bond markets could become volatile. Central banks would likely intervene quickly, providing liquidity through standing facilities or direct asset purchases. The objective would be to restore confidence before deleveraging accelerates. The collapse would not destroy the system permanently. It would expose dependence on short-term funding. The critical variable is credibility. If central banks remain trusted, disruptions remain contained. If credibility weakens, funding stress could propagate more widely. Repo does not fail through scandal. It fails through hesitation. After stress episodes, oversight often increases. Central banks refine standing facilities. Reporting improves. Participants adjust margin practices. Yet structural reliance persists. Repo remains essential for market functioning. Government bond markets continue expanding. Leverage remains attractive in calm conditions. The system stabilizes, but dependence remains intact. The repo market illustrates how modern finance depends on overnight trust. Transactions appear mechanical, but they rely on confidence renewed daily. Liquidity, leverage, and collateral chains are not static features. They are behaviors reinforced through repetition. Repo rarely draws attention because it usually works. Its importance becomes visible only during disruption. Understanding repo is not about predicting collapse. It is about recognizing that even the safest collateral requires willing lenders. When trust becomes cautious, funding becomes conditional. And in a system built on rollover, conditional funding is fragility.